The bull case, the copper supercycle, and structural demand catalysts. The primary driver of the bull case for Antofagasta is the structural shift in global copper demand. As of early 2026, the metal's fundamental value is being underscored by global structural trends, such as energy security and electrification, which propelled copper to record prices in 2025. The traditional link between copper demand and GDP growth has been augmented by policy-driven capital expenditure in sectors that are significantly more copper-intensive than the legacy economy. One of the most potent new vectors for copper demand is the rapid expansion of artificial intelligence and the high-performance computing infrastructure required to support it. Data centers are emerging as massive consumers of copper for power distribution, cooling systems, and connectivity. These sectors provide a demand floor that is less sensitive to traditional economic cycles, as they are driven by strategic national interests and long-term technological imperatives. The transportation sector remains the largest engine of growth, with the transition from internal combustion engines to electric vehicles representing a step change in copper intensity. A standard internal combustion vehicle requires approximately 23 kilograms of copper, whereas a battery electric vehicle utilizes roughly 83 kilograms. For larger transport applications, such as electric buses, the requirements can reach between 224 and 369 kilograms per vehicle, depending on battery size. This intensity differential implies that even modest growth in electric vehicle penetration has a disproportionate impact on total copper demand. Furthermore, the copper market is benefiting from the debasement trade, where investors seek real assets as a store of value amid global inflationary pressures and currency volatility. The industrial metal is viewed as an enabling material for progress, and its future availability has become a matter of strategic importance for major economies. This scarcity narrative is supported by the fact that the International Energy Agency projects a 30% supply deficit by 2035, unless there is a rapid acceleration in project approvals and mining investment. Financial performance. Antofagasta's 2025 financial results demonstrated the company's ability to translate high copper prices into record-breaking profitability. The group reported a 30% increase in revenue to $8.6 billion, driven by an 18% rise in the average realized copper price to $4.93 per pound and a significant increase in byproduct sales. This revenue growth was accompanied by a 52% surge in EBITDA to a record $5.2 billion, resulting in an EBITDA margin of 60.3%. This margin performance maintains Antofagasta's position at the top end of the global cost curve for pure-play copper producers. The company's earnings power is significantly enhanced by its byproduct credits, particularly gold and molybdenum. In 2025, molybdenum production increased by 48% to 15,800 tons, while gold production rose by 13% to 211,300 ounces. These byproducts serve as a hedge against copper production costs. The resulting byproduct credits reached a record $1.19 per pound in 2025, allowing Antofagasta to achieve net cash costs of $1.19 per pound, a 27% decrease year-on-year and a 5-year low for the company.
Antofagasta's management has demonstrated disciplined cost control through its competitiveness program, which exceeded its $100 million target for 2025 by generating $115 million in savings and productivity improvements. For 2026, the company has set an even more ambitious target of $110 million in cost savings, reflecting a culture of continuous operational refinement. This focus on controllable costs is essential for maintaining margins during periods of inflationary pressure in the broader mining sector. Growth Pipeline and the Nueva Centinela project. Antofagasta is currently executing a major material growth program designed to deliver a 30% increase in production over the medium term. The centerpiece of this strategy is the Centinela Second Concentrator project, also known as Nueva Centinela, which was approved for development in late 2023. This $4.4 billion project is a key element of the company's profitable growth strategy and is expected to add 170,000 copper equivalent tons per year to the output.
The project involves the construction of a new 95,000-ton per day concentrator plant that incorporates high-pressure grinding rolls technology. This technology is designed to reduce energy consumption and improve grinding stability compared to traditional ball mill circuits. As of the end of 2025, the project was progressing in line with expectations, with peak capital expenditure occurring during the year. The project has a 36-year mine life based on the Centinela district's substantial 2 billion-ton ore reserve.
In addition to the expansion at Centinela, Antofagasta is advancing growth-enabling projects at Los Pilambres. These include the expansion of the existing desalination plant from 400 to 800 liters per second and the construction of a new concentrate pipeline. These infrastructure upgrades are critical for mitigating the operational risks associated with water scarcity and ensuring that the mine can operate at full capacity regardless of climatic conditions. Furthermore, the Los Pilambres Development Options Project seeks to extend the mine life to 2051 and potentially increase throughput to 205,000 tons per day. Antofagasta's exploration activities also point to long-term resource growth. Total mineral resources increased by 104 million tons in 2025, primarily due to work in the wider Centinela district. The Cachorro Exploration Project in Chile recently received approval for a 7-year exploration program, signaling a healthy pipeline of future development opportunities beyond the current construction cycle. Capital allocation and balance sheet resilience. Antofagasta maintains a robust financial position that allows it to self-fund its massive expansion program while continuing to reward shareholders. The company ended 2025 with a cash equivalents, and liquid investment balance of $4.9 billion, representing a 14% increase from the prior year. This strong liquidity position is particularly impressive given that capital expenditure peaked in 2025 at $3.7 billion. Antofagasta's leverage remains extremely conservative, with a net debt to EBITDA ratio of 0.53x as of December 31, 2025. This robust balance sheet provides a significant buffer against market volatility and ensures that the company can continue to invest in its growth projects even if copper prices fluctuate. The company's investment-grade credit profile is a key competitive advantage in a capital-intensive industry. Antofagasta's dividend policy is another pillar of the bull case. The company maintains a policy of paying out at least 35% of underlying net earnings. For 2025, the board recommended a final dividend of 48.0 cents per share, bringing the total payout for the year to 64.6 cents per share, a 106% increase over the previous year. This total dividend equates to a 50% payout ratio, demonstrating management's commitment to returning excess cash to shareholders even during a peak investment phase. The bear case, fiscal uncertainty, and the new Chilean mining royalty. Despite the robust operational performance, the bear case for Antofagasta is anchored by significant fiscal and regulatory risks in its primary jurisdiction, Chile. The implementation of a new mining royalty framework has fundamentally altered the economic landscape for large-scale producers. This structure combines a 1% ad valorem tax on revenues with a margin-based component ranging from 8 to 26% for companies producing more than 50,000 metric tons of fine copper annually.
The maximum total tax burden for large operations in Chile can now reach 46.5%, creating a significant headwind for net profit margins. Antofagasta CEO has previously noted that these reforms would bring total tax rates on some operations to over 50%, making future investments in the country much more challenging and potentially hurting the long-term competitiveness of the local industry. This fiscal drag is a permanent feature that investors must weigh against the current high copper price environment. Furthermore, 2026 has introduced additional cost pressures through temporary fuel tax modifications. A new fuel tax structure is expected to impose approximately $100 million in costs over 6 months, with the mining industry bearing 74% of this total. This tax compounds the existing royalty burden and threatens the competitiveness of Chilean mining at a time when other regions, such as Argentina, are seeking to attract mining capital through more favorable fiscal incentives. The broader political shift toward resource nationalism in South America remains a persistent background risk. While Chile has a long history of mining stability, the recent years of tax reform and constitutional debate indicate a changing social contract, where the mining sector is expected to contribute a larger share of its rents to the state. For a pure-play producer like Antofagasta, which does not have the geographical diversification of peers like Rio Tinto or BHP, any further shift in Chilean fiscal policy has an outsized impact on Antofagasta's total valuation.
Operational headwinds and rising unit costs. While Antofagasta achieved record margins in 2025, the forward-looking guidance for 2026 suggests that operational headwinds are intensifying. The company expects copper production in 2026 to be between 650,000 and 700,000 tons, which is largely consistent with 2025 levels, but includes a reliance on returning Los Pelambres to historic grades. However, the cost of extracting this metal is rising. The cash costs before byproduct credits are expected to be between $2.30 per pound and $2.50 per pound in 2026. Even after byproduct credits, net cash costs are forecast at $1.15 per pound to $1.35 per pound. If molybdenum or gold prices were to soften, or if production volumes for these byproducts were to miss targets, the company's net cash costs could easily trend toward the higher end of this range, eroding the record margins achieved in the prior year.
The decline in ore grades is a structural challenge across the portfolio. At Los Pelambres, 2025 copper production was 8% lower year-on-year, reflecting harder ore types and lower copper grades. While the company expects a grade-related recovery in 2026, the long-term trend of declining grades across the industry means that miners must process more material just to maintain existing output levels. This increased throughput requires higher maintenance activity and energy consumption, leading to inherent cost inflation that is difficult to offset through productivity improvements alone. Capital expenditure also remains a major drain on cash flow. While Antofagasta announced that peak capex was passed in 2025, the 2026 guidance still calls for a massive $3.4 billion investment. Any delays or cost overruns at the Centinela second concentrator would not only delay the 2027 production ramp-up, but would also consume a larger share of the cash flow generated by high current copper prices. The technical complexity of the expansion, including the integration of autonomous fleets and HPGR circuits, introduces execution risks that are common in large-scale brownfield mining projects.
Labor relations and systemic logistics risks. The Chilean mining industry is highly susceptible to labor volatility, and 2026 is a critical year for Antofagasta in this regard. The mining division has 4 major labor agreements scheduled to expire, 3 at Centinela and 1 at Zaldívar. Additionally, the transport division has 6 agreements due to expire. Labor negotiations in Chile frequently involve high stakes and can lead to operational disruptions if an impasse is reached. Recent history illustrates the systemic risk posed by labor actions. In January 2026, a 5-day strike by workers at Finning Chile, a major equipment service provider, created logistical blockades along the Ruta de la Minería in the Antofagasta region. This action blocked access to both the Escondida and Zaldívar mines, demonstrating how a single contractor dispute can paralyze multiple world-class operations. The settlement required substantial financial commitments, including conflict termination bonuses of approximately 14,500,000 Chilean peso per worker.
The success of these contractor unions in securing high settlements can create a benchmarking effect, where direct mine site employees demand similar or superior compensation packages in their upcoming negotiations. Furthermore, the strategic timing of strikes, often occurring when copper prices are elevated, maximizes the economic leverage of unions, as every day of lost production translates to millions of dollars in deferred revenue for the company. Logistical concentration is another systemic vulnerability for Antofagasta. Chile's mining geography often relies on single access routes and infrastructure corridors that serve multiple operations simultaneously. Roadway blockades, weather-related disruptions, or infrastructure failures can lead to cascading operational constraints across the supply chain. The January 2026 Finning strike proved that neither the mines nor the contractors possess sufficient operational buffers to weather prolonged service disruptions along these critical corridors. Market surplus risks and valuation premiums. The final pillar of the bear case concerns the potential for a near-term copper market surplus and the stretched valuation of Antofagasta's shares. While the long-term structural deficit is a central bull argument, several leading analysts warn that the 2026 market balance may be looser than expected. Goldman Sachs, for example, has lowered its 2026 copper price forecast to $12,650 per ton, citing weaker global demand growth tied to energy price shocks and an increased market surplus of 490,000 tons. Higher current prices are also expected to dampen demand growth and encourage the use of scrap copper. Goldman Sachs expects the global copper surplus to expand as high prices incentivize substitution and secondary supply. If a definitive decision is made regarding U.S. refined copper tariffs in mid-2026, it could signal the end of U.S. stockpiling, allowing prices to correct toward their fundamental fair value, which analysts estimate at approximately $11,100 to $11,500 per ton. Antofagasta's valuation also appears high relative to its historical averages and industry peers. The stock trades at an enterprise value to sales (EVS) ratio of approximately 6.6x, which is 89% more expensive than its 3-year median of 3.5x. On a price-to-earnings (PE) basis, the stock trades at 33.9x, significantly above the peer average of 18.9x and its own estimated fair ratio of 23.9x. This premium valuation suggests that much of the bull case, including the high copper price environment and the medium-term production growth, is already priced into the shares. With 7 analysts presently covering the company giving it a consensus recommendation of hold, there is a risk that the stock lacks a further catalyst for appreciation until the next phase of its growth projects is successfully de-risked. The risk of a D rating is significant if the 2026 copper market moves into a deeper surplus than currently anticipated by the bulls.
Conclusion: Antofagasta's bull case is firmly anchored in the structural, policy-driven demand for copper as the linchpin of electrification and artificial intelligence, coupled with an internal growth pipeline that is set to deliver a 30% production increase by 2027. However, the investment case is not without its vulnerabilities. Antofagasta is uniquely exposed to the shifting fiscal and labor dynamics of Chile, a country where the mining sector is facing increasing tax burdens and sophisticated union leverage. The transition from a record 2025 to a 2026 defined by rising unit costs, heavy maintenance schedules, and a series of critical labor negotiations suggests that the easy gains from the copper price surge may be in the past. The valuation of the stock is currently at a premium, reflecting a market that has largely priced in the company's growth potential while discounting near-term market surplus risks. For the long-term investor, Antofagasta offers a resilient balance sheet, superior environmental stewardship, and a clear path to production scale. In the near term, however, the share price will likely be sensitive to the outcomes of labor negotiations and the trajectory of the global copper balance.